Yes.
So you can go through the recordings as well. Capital market.
Okay.
In a word itself, if you see capital market, it means it is a place where companies and even government right, they approach to the investors. When we say investors, here you would see three people or three categories. One is fund or funds, you can say. Second would be your HNI investors. When we say HNI, it means it's a wealthy people like
Highly
Rajnikant.
investors. Yeah.
Yes,
High net worth investors. Yeah.
yes, high net worth individual investors, right?
Okay.
And then retail people. If you see, as I said, when we say capital market, market it means it's a place.
Okay.
It's a place or platform. Place or platform. So now you can form your own definition. When we say capital market, companies or government, when they need a funding
Okay.
to raise funding, if companies want to raise funding, then they approach to the investors. So investors, it could be funds, HNIs, or retail investors or common people like us, where
Okay.
they subscribe they subscribe the let's say to raise funds through equities and debt, debt instruments.
It is. Okay.
So it means HNIs, funds, or retail people, they participate in the equities or debt instruments and
Okay.
subscribe to the investment again to the investment and provide funding to the companies or even government
Okay.
for that matter,
Mhm.
right? So
Yeah.
government also raise capital market provide capital market means companies can raise short term. Short term it means not very short term. So you can say instead short term, say medium term
Okay.
and long term funding. Funding through capital market. Take a screenshot and see how I have linked each and everything to each other in a
Okay.
very simple way. Capital market, it means it's a place where companies and companies, government, or potential investor or investor like who are willing to take a risk, they come together and buy and sell in securities. Because companies and
Okay.
government sell the securities, investor purchase securities and transfer funds to the companies for doing business activities. When we say capital market, it's a platform that offer or enable facility to the investor and even companies or issuer, I would say, who want to issue their instruments or securities in the market, like equities or debt instrument, as I said, right? And
Yeah.
then they Means again, people or funds or institutions, they participate, they subscribe to the shares. Shares like equities, shares like preference shares, right? When we say equities, you would see two types again here: common stock and preference. Here you would see bonds and debentures. Third would be loans. Say this: loans, debentures, bonds. Through that, companies will raise funding for their medium term. Don't use word short term. Directly use medium term or long term funding through capital market instruments. And when we say capital market instruments, that would be your equities. It can be common stock. It can be preference stock. It can be debt instruments or bonds. So now if you ask me, so what are the platforms where companies they can list their instruments or they can raise funding through such a platform. So now if I take example, let's say we have NSE, National Stock Exchange.
Okay.
We have BSE, Bombay Stock Exchange. When we say stock exchange, it means it's a market, right?
Yeah.
So you can say exchange, it means stock exchange. That comes under your market. Then even though we have Chennai Stock Exchange as well, Pune Stock Exchange, Bangalore Stock Exchange. So it means even local companies also they can list their shares on a stock exchange platform, buy and sell, in a securities. Are you getting me? Any question, any doubt? Now I hope you got the answer of your first question.
Yeah. So
So you
what they will ask in for interview for related type.
okay? So
So
do
they
you
will
have
ask for
experience?
how capital markets work in the.
How, see now, if you have experience, then they'll not ask question like what is capital market. If you are a fresher, they'll ask question like what is capital market.
I am
Now,
experienced
if you
6 plus
have
years.
experience, then your question will change like how capital market works. And if you see now, I have answer to that question like how capital market works.
Okay.
Capital market works in this way, and you should explain like this. Then only they'll entertain. Okay, good.
Okay.
If you only explain like definition, nobody entertains.
Okay. So I have to explain like companies and governments, they will raise funding and they will approach the investors. This kind of thing I can explain. This is good.
Yeah. Then mention the funds, HNIs, retail
Ah,
investors.
yeah.
Also, you should take the instrument names like equities, common stocks, or maybe
Okay.
preference shares, debt instruments, right? So
Okay.
you should take that. So
Yeah.
they raise the funding to fulfill their medium term and long term, their investment goals.
Okay.
Right? This is how you can relate
Okay.
and explain. All right. So now
Yeah.
I believe we are good on this.
And they will ask whether you have worked in capital market side means like I worked in that derivatives I worked. So I'm working in
Derivatives
private
also
equity.
comes under capital market. Capital market is not a different one, but here if you just link that capital market with only equities and bonds, then you won't understand, right? So it means under capital or NSE and BSE, if you see derivatives also, a company's list like future and options. Those are the listed ones,
Okay.
right?
Yeah.
Other terms that you have asked under again same question like capital market. If you see capital market has a types.
Okay.
Capital market has two types. One is primary.
Secondary market.
Primary market becomes your gray market. gray market.
Okay.
All right, and secondary market. Secondary market, which is a famously known, for exchange of securities. So it means you can say, you can put examples here. So that becomes your secondary market. So it means the place even, right? Bombay Stock Exchange building.
Yeah.
So you
Yeah.
can go and check there, and you
Mm-hmm.
can exchange your securities.
Mm-hmm.
But here in a primary market, as I said, gray it means, so we don't have any place as such. There is no central
Mm-hmm.
place.
Okay.
There is no central place. So it means if you see, let's say you are a buyer,
Okay.
there is a company, let's say ABC Group. So you can directly approach company, or company will directly approach to you for investment.
Okay.
So that becomes your primary market. So for example, if I talk about, let's say, IPO,
Yeah. Initial public offering.
initial public offering. So you guys directly approach to the companies through broker, right? So it means once you open an account, you can send request to the directly issuer. Means who is going to issue that securities or shares, your request will receive to that company directly. The company will work on your request, and they'll provide you the details accordingly, whether they have a securities or not. So that becomes your primary market. So it means buyer of a security, or people like who are willing to invest, that they can directly approach to the company. And that's what I said, there is no central place like BSE or NSE. That's the
Mm-hmm.
difference. That's how you can compare.
Okay.
Another big difference that you can see, fresh security IPO you can issue in primary market.
Okay.
Even FPO, further public offering, you can issue in primary market. For all new securities, issue in gray market. And the another big difference is big players or HNIs or funds, they also make trades in gray market.
Okay.
HNIs, it means in
High
highly
network clients.
network clients or fund houses like ICICI, JP Morgan, Goldman Sachs, fund houses, right? And if we see secondary market, BSE, NSE, where which is easy accessible market, easy to access, shares will be listed. And one more important point that you would see here, means securities, shares or securities issued in primary market will be traded in secondary market. Very important one, statement. If we see, if we issue any IPO securities, you can issue that in primary market. You can
Mm-hmm.
negotiate with investor, you can discuss, right? You can issue that securities even for bonds as well. So bonds or even fixed income, through private placement memorandum, even bonds that you can issue in primary market, you can negotiate. And then after you can list that securities on stock exchange. So similar way, If you, let's say, if you have ABC Limited, you can create shares, right? Units. You can issue that units to the people like who are willing to purchase, and once they purchase, you can directly approach the NSE or BSE, and you can list your securities on NSE as well as BSE or any other stock exchange as well. So now your question would be like, so why listing is important? If you don't list securities on BSE and NSE, then how they means investor will make money? How trader
Okay.
will make money? They won't be able to generate any profit then. Why? The reason is the share capital is perpetual capital. Perpetual capital, it means company will not return capital to the investor back until company announce any liquidation or bankruptcy, right? Or if
Company will not return the money.
if you invest in equity, company will not return money to you
Okay.
unless and until, let's say, company has any big event like liquidation, maybe bankruptcy, right? Or maybe, let's say, company want to shut the business, or company earn lot of profit and now company want to return the share capital. In that case, that is fine. Those are voluntary actions. So means that would be where announced by the company where they can approach, but investor cannot claim for money. Let's say if you're holding Wipro company shares, you cannot go to the company and ask for a return of capital. They'll not, because it's a perpetual capital. That's what most of the companies prefer, to raise permanent capital from the public or people like us or HNI investors, like wealthy people or funds. That's what they prefer it. Then why should I go with the, see, to raise capital through equity? Again, it is a costlier method. It means to create a shares, to appoint depository, appoint, let's say, stock exchange, designated stock exchange, then again to appoint registrar who can maintain the register of all investment or investors, and then execute the trades on a stock exchange. So it's a costlier process. Every time we will have to monitor your shares and everything, right? And then pay the huge fees to the all participants. So it's a costly business or transaction, I would say. So why should I approach that? And apart from that, let's say, uh, again, the investors are asking fixed dividend and all. So that becomes costly method or fundraising strategy for me, right? So as a company owner, why should I do this? Put a logic, and that's what it becomes perpetual capital. Perpetual capital, it means you don't need to return that capital to the investor back. All right.
Yeah.
Here you may, so this could be your question two. So capital market types.
Okay.
Here you may expect question like how companies issue securities and all. So your answer should be companies issue securities in primary market, or you can call it gray market, where people like us or the HNIs or other institutions that participate to subscribe securities. So it means that all subscription process or issue of securities legal process will be done in primary market only. And once the company, or let's say that we are done with the legal proceeding, then we can list that securities on reputed stock exchange like BSE and NSE for a trading purpose, where investor they can exchange the securities with each other, right? So that's the another aspect, so that you can explain. Then why secondary market? Because secondary market help investors to get their money back, not from the company, but from the other investor. So again, your question would be like, let's say, how, sir? Let's say you have participated in Wipro shares in IPO,
Okay.
and you have purchased one share with, let's say, 100. As I said, you cannot approach to the company to pay your 100 rupees back. But company listed on, let's say, BSE, and on BSE, let's say price of that Wipro is 350. So you can send your request with one shares that you also want to sell one shares at 350. And I'm sure if people who are looking for a buy in Wipro, they'll approach you, and that's what your stock exchange help to get the buyer. If you are a seller, so that stock exchange help you to get the buyer uh, to your securities through their NSE or BSE platform, and that's what I said. So those are platforms or marketplace.
Okay.
Marketplace, it means where buyer and seller can exchange the goods and services. So that platform you can call it as a market platform. And here, then you can sell your securities to the potential buyer. So buyer will pay you 350. So what you understood is secondary market provide capital supply to the companies indirectly, not directly. But primary market support companies to raise funding directly. Because here company has no control on the stock. Anyone can buy it.
Mm.
Let's say you are the buyer of, let's say, Wipro stock initially or few years back. Now you want to sell that stock, you can sell that to me, then I'll owner of that securities. They'll get 350, I'll owner, I'll hold. And again, if I want to sell, again I'll go to the market, secondary market, and sell it out to someone, and then someone will purchase it. So this is how market works. Now you let me know if you have any question as such. But
So they will ask one question like whether you worked on primary market or secondary market. I worked on reference data provider for IPO. So how I can answer for this kind of questions?
which one?
So whether you worked on capital markets like primary
No
market,
one
secondary market,
asks question like IPO. IPO is an underwriting process,
Mm.
right? Underwriting, it means you should know the legal terms. You should know how IPO book building price works. You should know that how you can calculate the valuation of companies and all. So have you worked on it? I'm sure no, right?
No.
What is your profile?
Actually, what we collect reference data, like from exchange, we will collect the IPO's notices, like when it was listing, and then we are just creating the symbol, like example, instead of E colon ABC. So we are just a provider of reference data, like I sense it all
That
QC.
is a different. I know it. Reference data, I know it. So
Mhm.
here you would see market data or reference data, or maybe that you will work on the securities or events, different events, and to check their to get the references and update it in the internal accounting system. So that's how your reference data team works. But nobody asks question on like have you worked on IPO for, because I'll tell you why. To
Mhm.
work on IPO, it's not an easy thing. So where companies hire legal advisors, they
Okay.
hire qualified chartered accountants. They hire valuers who are expert in calculation values and all.
Okay.
And then they also hires, means companies also hires legal entire team who can calculate the value of each equities. Then who can check their all legal, their documentation, compliance, regulations, and everything, right?
Okay.
Because to send the draft to the SEBI for approval, it's not an easy job.
Mhm.
It's not like debit and credit and do it and your job is done. So no one asks that question. The reason is you have a reference data profile.
Mhm.
And if someone asks question like, hey, have you worked on IPO or not? So maybe the requirement would be that. But that doesn't mean every investment bank they'll ask like same question. No.
Okay. Mhm.
Okay. And that would be again irrelevant. If let's say for example someone is hiring for let's assume it for a trade processing. and that guy is asking about how you can prepare IPO, right?
Yeah.
Documentation and all. So there is no relation of that IPO and your trade processing. Trade processing is a back end process. IPO is a front end process where lot of legal, aspect that you need to verify, check, and then design the model, that investment model, which can help investors to make money, and also that help company, means your company, to generate, let's say, capital.
Okay.
Right.
And one more question. What is the difference between primary market and secondary market?
So that's what I explain it. If you see
Yeah.
primary market and secondary market, I have explained a lot of things. So you can see the
Yeah.
differences. So where companies issue securities in primary market. If you want to issue securities, that you can issue in only primary market, not in secondary. Secondary market is a platform, just a platform that you can list your securities.
Okay.
But all your IPOs, FPOs, all new securities, even bonds, that you can issue in primary market. And there is no
Okay.
central place. Central place, it means there is no building which you can, let's say, name it as okay, so this is a BSE, this is NSE. No, that's what I said. It's a customized market where investor, they directly approach to the company, and company directly approach to the investor. So they design investment plan, and once they are agreed with their terms, they list that security on stock exchange. So that
Okay.
becomes your listed stock
Mhm.
exchange, right? And if you see
Yeah.
secondary market, so as I said, secondary market, which is easy to access to anyone. Anyone can buy and sell the securities.
Yeah.
Shares will be listed on a stock, I mean, secondary market only. So that NSE and BSE, best example that you can give. BSE and
Okay.
NSE is a part of your secondary market. And
Okay.
third thing, as I mentioned, the big difference is securities or shares which, let's say, has already issued in primary market,
Secondary market.
so that will be traded in secondary market or
Secondary
listed
market.
in secondary market. So these are the key differences which you can highlight.
Okay. Yes, sir.
Okay, so
Yeah.
can we jump on next question then?
Yeah, sure.
So your next question is derivatives.
Okay.
Next question is derivatives. When we say derivatives, it means, if you see, it's a possibility, right?
Yeah.
Possibility of what? Possibility of risk, possibility of price change, possibility of, let's say, to win and loss or lose competition. If you have a possibility of risk in trade, then you can look for a derivatives. If you see any possibility of price change, whether it could be up and down, then again you can look for derivatives. If you see the possibility of win and lose or loss something, then you can again approach, or you can look for a derivatives. So when we say derivatives, it means it's a possibility, right? But if you
Yeah.
want to, let's say, consider possibility, then you should have to have uh, under underlying securities. You should have to have underlying securities. Now your question would be, so what could be my underlying securities? It can be anything. It can be anything. So now your question would be like, how can you say it can be anything? Let's say, see, if you don't have your own, let's say underlying security, then how will you make the trades and how will you consider that you have a possibility of risk, right? How will you consider that you have a, possibility of price change? If you don't have a possibility, then why will you enter in any of the derivative contracts? Think about that, right? It is all about game of your mentality. If you mentally believe that, let's say, you have a possibility of price change, then definitely you can sign derivative contract immediately and get into it and just wait for price change then. So that's how your derivative works. And as I said, without underlying security consider, you cannot go ahead in the derivative contracts. But what about the again underlying securities? As I said, underlying securities, it can be anything. So now your question would be like, so how can you say it can be anything? For example, let's say assume it. If you are an investor, for you, if you are an investor, let's say, for you, the securities would be stocks, bonds, loans, fixed income securities. If you have any of the instruments with you, you can sign derivative contracts. Again, your question would be like, if I don't have it, that's fine, but at least you should assume underlying something. If you don't have it, then you can assume it. Otherwise, you cannot sign the contract. So now your question would be, let's say, sir, I'm not an investor. Then what could be the, let's say I'm a farmer. For a farmer, let's say there is one farmer who is producing cotton. So cotton would be for a farmer, it could be cotton, it could be, let's say, seeds, sugar, even sugar cane also. So farmer can sign the contracts for a sugar cane, cotton, seeds, or even turmeric or any other products, agricultural goods. So for a, let's say, sir, what about, let's say even I'm not a, I mean, farmer, I'm not a investor. Let's say I'm a trader. So that depends. What means in which segment that you guys are doing trading, right?
Yeah.
If I let's say talk about uh, you're a trader of cotton, then you can sign the contract for cotton. Let's say your question would be like, sir, suppose I'm not even trader, but I'm a distributor. I'm petrol or chemical distributor. So we used to distribute, let's say, or we are distributing, or we are a distributor of oil or petrol or diesel. Even though you can sign derivative contracts. Why? Because see, every petrol pump owner or distributor, they'll try to protect the price change because price change is a big risk. So now your question would be, so how can you please explain with example? I'll explain it. Let's say you are a distributor. You have your petrol pump, right? You're a petrol pump owner. You have purchased oil. You have purchased oil with, let's say, per liter, let's assume it, 30, right? And petrol cost also that let's say incurred 30, and your profit margin is let's say 10 per liter, including taxes, something that you can say. And if you see 30, 30, 70 rupees, so that would be the price, market price, let's say, market price, where people like us, common people, right? So they can buy that particular oil. So now if you see current market price is this, right? 70. But if you see why derivative will come into picture, this guy purchased oil or cost of, so for this person, this becomes cost, right? Cost, it means minimum 70 rupees that this guy will expect. This guy will expect. Why? The reason is, so 10 rupees is profit, then cost, which is a by default. So it means nobody want the price should drop, below the cost price. So then that it becomes then, I would say, loss making deal. And then per liter price, it means, let's say, assume it, this is the international, price where that crude oil trades at that price. Let's
Okay.
assume it now. And if you calculate costing, that goes around 70. So every petrol pump owner, they'll expect 70 rupees for per shares. Let's assume it due to the Ukraine and Russia border escalation or war, that oil prices dropped in market. Huge drop it means. So instead, this, if you see now current market oil prices, let's say per liter 30 rupees. Who would be in profit? Who would be in profit in this case? If the current market price is, let's say, due to that, Ukraine and Russia war, price drops. Who would be in profit? Common people, correct?
Yeah. Yeah.
Because they'll get oil at cheaper rate. So it means they'll
Cheaper at 30 rupees. Because purchaser have 70 rupees.
and distributor purchase that oil would be in loss loss of 40 rupees.
Okay.
40 per liter. So think about it, how this guy will mitigate the price change risk or risk, downside risk.
Okay.
If the price goes high, then definitely this distributor will be in profit. Right? What if you see the different one, the different example in opposite direction? Same example, let's say, due to the Russia or Ukraine war, the price goes up, and now the price is, let's say, 90 rupees for per liter.
Okay.
Price goes up, let's say, up. If the price goes up, so if you see, just try to understand this equation. If the price goes up, so now it means this guy will make money then. Correct?
Yeah. Yeah. Distributors
20,
will get money.
20 rupees profit for per securities or per liter. So now, if you put a logic, if price goes up, you don't need to sign any derivative contracts. Why? That is not your risk. If you are a trader, you can do it. But if you're a normal distributor, you don't need to worry about positive price change. That positive price change help you to generate more money. That's fine, right? After that means your current price was, let's say, considering cost and everything, price was 70. And if price goes beyond that 70, then definitely your distributor means you are a distributor, so you would be in profit. So you don't need to worry about positive price change. But what if price, as I said, price goes down? Then how can I mitigate that risk? The question was that. Now price is 30 and we have a loss of 40 per liter. So how we can mitigate that risk? Because this is a risk, correct?
Yeah.
How we can do it? So this is, comes under your derivatives. And here derivative help you to mitigate that risk. Derivative word, which is, let's say, it seems little complex or, difficult. But if you see derivative, it means possibilities. And as I said, I have decoded it already. So if you have a possibility of risk, possibility of price change, possibility of win or lose something, then you can find your underlying securities. Underlying securities, as I told, that security changes, depends on your character. If you are a farmer, then that securities could be your agricultural goods. If you are a distributor, that depends on your distribution, again, goods and services, what you are offering to your client. If you're an investor, it could be stocks, bonds, loans, fixed income, etc. Depends on your character, what character you are playing. If you are, let's say, gold seller, gold, that would be your, you know, underlying asset or underlying securities. If you are a bank, then deposit amount, whatever deposit amount that bank has received, so that becomes the underlying security. So it means depends on your character, depends on your means at what side that you have or what character you are playing in this derivative segment.
Okay.
So that means depends on your character. Most of the people, what they believe, only stock market or this market has a derivatives, but which is not true. Even in normal life also, hundreds of time we make promises to the to each other. Let's say, please, can you borrow me, let's say, amount 100 rupees, 200 rupees, let's say 1000. If that person borrow you, and if you you know follow that obligation or oral commitment, so that becomes your derivatives. Or what if, let's say, someone is asking you for money, then you said like, hey, without any reference or see any asset, I cannot borrow or lend any money to you. So as a borrower, let's say, I have deposited my properties document with you, and then you have issued 10 lakhs to me with 10% of interest payment. So that becomes a derivatives. Why? Because
It's an agreement.
yes, we have an agreement, or you have asked to deposit agreement. And go and check it, 90% people means, even in village also, they exchange or they do in, trades in derivatives. They don't know the trades, they can call it as it's a derivatives. That's the difference.
Okay.
If you put everything on legal paper, that becomes your derivatives. But if you don't, but that doesn't mean that won't be your derivatives. That would be. But that oral derivatives has no place where you can, at least showcase or express that, yes, I have signed this oral derivatives, or I have oral derivatives with this and that guy. Even also, if I talk about your moms, right? Sometime you would have seen where they exchange, let's say, sugar with the other, products, or maybe the different, seeds or any other, things or grains with the maybe rice versus, you can say, wheat or other, grains. They exchange it with their neighbors, correct? That happened, right? Maybe if you're
Yeah.
not from, let's say, village, but in village, you would see that it's a usual practice, daily routine practice. So it means a derivative is not a new one, it's an old concept. In past, we had barter system. We used to exchange products or goods or services, whatever that we have. White versus rice. What was that? That exchange also comes under your derivatives. So now, if I ask question to you, what you have understood from this discussion about derivatives?
Um, Derivatives, it's like possibility, and we have possibility of risk and price change or gain or loss. And then possibility in the sense like we have underlying securities. Underlying securities, it's an can be anything like stocks, bonds, loans, fixed income, everything.
Yes. Means this is how you can explain to the panel as well,
Okay.
right?
Yeah.
So now here I'll explain this quickly. So if you see
Okay.
this, if the price drop in the market, then this guy will bear the loss, means distributor will bear the loss. Then how
Yeah.
this guy can mitigate the risk, and how means derivatives, help people to mitigate or reduce their risk from the contracts. So this guy can, this guy can sign, let's say, forward contract. Even this guy can sign option, put options, or even this guy can sign or enter into future contracts as well. Again, your question would be like, I don't understand signed it means. So, as I said, if you don't have, a possibility of price change in your mind, or if you're not mentally, thinking that perspective, then you cannot sign derivative. Simple. Derivatives, it means it's a possibility. So now how this will work? Let's say there are three participants as we met. One is distributor, right? Another
Yeah.
one is, let's say, as I said, common people. So they don't care about it, what happened in market. So they buy it, right?
Okay.
And there is a one more guy. You can call it, let's say, uh, you can say trader. Here is one distributor. There is one trader and common people. Per liter price, it was 70, but as I said, if the price goes up beyond this, then this guy distributor would be in profit. It's a oil, market. So now you don't need to worry about positive price change. You would be worrying about only negative price change. Correct?
Yeah.
Then you can sign forward contract. Forward contract. Forward contract with, let's say, you can sell 1 liter at 70. So it means you can sign this contract with this trader. So now your question would be, sir, this is a direct risk which I can see, right? So why should
Yeah.
I, means as a, let's say you're a trader, then why should I enter into this contract? If I again buy this particular contract as a trader, then trader will receive that loss of 40, correct? Then why this
Yeah.
guy will buy this contract? See, as I said, derivatives, it means it's a possibility. This guy has a possibility of, you know, negative price change risk, and this guy will again, uh, this guy will, look for a positive price change. If both people think about or think in the same direction, let's say negative, negative, if both people believe price will drop, then no one will sign derivative contract. If let's say A is thinking about price change for oil, then B will think about price up again for oil. Then only these two characters or two people come at one place, and then they make trades in derivatives. This is how your derivatives works,
Okay.
right? That
Yeah.
means if you think like, again, this person and this person both will think about price drop, then why trader will sign the contract? So eventually, now if you see price drops in market, how calculation works, see this. Let's say current market price is 30, and this guy sell the, means this distributor sell the petrol 1 liter at 70. So now if you see, let's say this deal, when this person distributor purchases oil on 1st January, and at that moment this contract, let's say, was signed 1st Jan only, so that contract was signed. And today,
Mhm.
let's say due to some political change or maybe government change or international, issues, price drop in market, and the current market price of a petrol is on, let's say, 20th of September, the price which is 30 rupees per liter. Now, this guy, means distributor has a legal agreement. So this guy will claim, hey, listen, I want to execute this contract. Today is 25th of, let's say, 20th of September. So I want to execute this contract. Then trader will have to pay the difference. Difference, it means, let's say contract signing price was 70, and the current market price which is 30. So if you see contract price that 70 minus current market price 30, so it will be 40. So this guy will send 40 to this one. So distributor will receive 40, and if you see when distributor sell this petrol to the common people, so this guy means common people will pay 30 plus 40 that trader will pay, right?
Okay.
So
Yeah.
means now if you see distributor mitigated risk, right? Now your question would be like, so then who has incurred losses? So trader has incurred losses due to incorrect prediction, or the trade goes against his prediction. So it's a prediction. For
Mhm.
example, let's say now we have a match, India versus, Pakistan. We are just predicting who will play well, how they will play it, and India will win the match. It's just a prediction. It's not something that, definitely India will win or Pakistan will win, right? It's just a prediction, and then we bet on such a players like, okay, let's say India will win, then I'll bet 1 lakh. Someone will say I'll bet 2 lakhs. So this is how it works. So this is all about derivatives. Derivatives is a very vast topic, but I'm just trying to explain that term so that you can
Mhm.
relate
Okay.
and explain at least.
Okay.
And same logic that you can now apply with the stock prices. Same logic. Replace the
Okay.
oil word and say it's a stock.
Stock. When the stock price is negative, so they will go for the trader.
Yep. So stock price, it goes negative. So now instead distributors just change the character, say holder.
Holder. Okay.
You have a one stock with 70 rupees price. If the price goes above the 70, then you would be in profit by default, right? Why
Ah,
you
yeah.
would be worrying about that particular, uh, that upside, let's say momentum. Always we want benefit. But what if price goes below the 70? That would be the concern for you, and that's what you can sign agreement, or you can
Forward contract.
not only forward. As I said, there are
Yeah,
multiple options.
forward options, put options, and future.
Right, there are multiple options you can take it. Right, there are multiple options you can take it, and you can sign contracts with the trader, or like who are willing to sign contract with you. And if they sign, then if you see, whenever you want to sell that security or execute trade, so you will receive 40 rupees from the trader if price goes down, and then he will receive the other benefits. Means that market, whatever, whenever you sell that security, let's say you have received 30 from the people, or that, let's say, buyer of a security, and then 40 from the trader, or any person who is ready to or willing to take a risk. Why now again vice versa? Why this guy took a risk? You should ask this question to yourself. As I said, it's a prediction or possibility.
Mhm.
So now just think differently. What if instead price goes down, current market price is 130? Then you will have to pay as a distributor, you will have to pay 60 to this guy. So it means in that case, trader would be in profit ultimately. Trader will make the money 60 from one stock, and this guy will enjoy all benefit. Why? Because current market price is 130. So this guy will ask you to sell your securities at 130, take or keep your, let's say, capital, which is 70 back, and pay the remaining amount, whatever that you would see, pay that to me. So this is how market works. It's not something where only one side of people they'll take and they'll get in a profit. No. All right.
Yeah, okay.
So are you able to understand or not? It's a quite vast topic. We
Yeah, yeah, I am
derivatives
understanding.
required minimum 1 month's trading, then only you can understand. But I'm trying my level best to explain it very short you know
Okay.
terms. But those would be fine to prepare for an interview.
Yeah. So they will not ask any definitions in interview for the experienced people.
Why definition? And even though if they ask, I told you the definition. Definition,
Yeah,
it
yeah.
means
I
it's
attended more interviews previously. So 1 year back, I have not attended any interview. So they asked about the dates. So can you tell me this definition, that this definitions and all.
see,
So that's what I asked.
you don't need to bother about, in my session at least, you don't need to bother about your that things like definition and one liner. Nobody's interested.
Okay.
People that are interested in this full discussion. You're not, as
Yeah.
I said, that's what I asked first question, like, are you fresher? You said no. Then why you should worry about your fresher? And if still, if you want definition, I'll define
Mhm.
that, don't worry. Derivatives,
Okay.
it means it's a contract of financial instruments which derives the values of that underlying assets on the basis of market situation, or underlying assets. It can be stocks, bonds, debenture, agricultural goods, or it can be anything, or even currencies as well for that matter. That
Okay.
becomes a derivatives. Derivatives, it's a financial contracts which derives the values of underlying securities.
Okay.
I also define the same, but I thought like you couldn't get that, and that's what you're asking again for a definition.
No,
Definition is
no, it is
nothing.
very easy for me to understanding this kind of thing and reading definition. It will be very, I will get forget. So this kind of explanation, it will be very key point for me to explain in the interview part. It will be easy for me.
Yes. Don't focus on definition. You can see, I'm giving you this insight where you can create your definition.
Yes.
There is no legal definition which defines. When we say contract, it means even they haven't defined what could be comes under your contract. So you can add them, right? You
Yes.
can sign that derivative contracts for any things if someone is ready to sign with you. Simple.
Mm.
So you can create your own definitions.
Yeah,
Now,
it will be easy for me for creating now.
yep. If you have a keywords, if you have, let's say, means this kind of discussion, you can create a definition on your own. The
Mm. Yeah.
important topic that will cover under derivatives, derivative types now.
Okay.
So you may expect question on, let's say, question number 3. What are the different types of derivatives?
Futures options.
Note down this. Swaps. I'll just brief famous one swaps. There could be many more. Interest rate swaps, credit default swaps, and currency swaps. Right.
Yeah.
Forward contracts. Forward contracts. You can buy forward, you can sell forward. But apart from that, there would be two types: deliverable and non-deliverable. Non-deliverable. So you can buy the let's say forward contracts, and even you can sell the forward contracts.
Okay.
And when we say deliverables, so it means you can ask counterparts to deliver that product. So there would be two ways. One, you can, here if you see in this case, this guy can directly ask you to, send 1 liter petrol. If let's say I'm bearing the loss of 40, then I'll ask you, hey, do one thing. I'll pay you 70 rupees, send me 1 liter petrol. Simple. So that becomes deliverable, right?
Mm. Yeah.
But instead, petrol, let's say, if I ask you, what if I only send you 40? I'll send you 40, you keep your petrol with you, that's fine. You keep 1 liter petrol with you, I'll send you 40, the difference of 40. So that becomes non-deliverable. Did I deliver anything? No. I
No,
just pay the
just you
difference.
pay.
Pay off the losses. That's it. So that
Okay.
becomes your deliverable. Sorry, non-deliverable. If you pay only payoffs or difference of a contract, that becomes your non-deliverable contracts. And if you see at the expiry, if you are delivering something, then that becomes your deliverable contract.
Okay.
What about swaps? Again, swap, as I said, so topics are very lengthy, right? I'll first of all
Mm.
brief you this one, and I'll try to save this presentation if I can. So next time, if we can refer that, right? Swaps, it means you
Okay.
can exchange it, but I'll quickly just go through it. CDS, you can, CDS, it means credit default swap. So you can exchange risk with any counterparts. How can I exchange that risk? If let's say you have purchased one security, or let's say not security, I'll quickly explain in a different way. Let's say you have purchased car worth of
Okay.
rupees 10 lakh.
Okay.
Then what could be the risk that will, with your new car, accident or any damage, right?
Yeah.
Then what will you do? What will be the best option to protect that risk?
Insurance.
Insurance. Exactly. So CDS means your insurance. But this CDS, we are talking about investment. If you have invested, let's say in XYZ company, let's assume it in Adani bonds, right? Adani green bonds. But you know
Okay.
it. So you have purchased bonds for next 10 years. Now you cannot sell it. Let's say that is the obligation. Then how you can protect that risk? You can purchase insurance from the LIC. Why? Because you are concerned about your investment. What if Adani announced bankrupt, or let's say a default on payment? Then who will pay my, let's say, principal or interest payment? If you want to protect your investment, then you can purchase CDS. And who sell the CDS? Insurance companies sell the CDS. You can purchase CDS by paying premium, let's say 1% of your investment, maybe 2% of your investment. So what if, sir, then Adani, let's say I'm holding any CDS, I have purchased CDS, and now Adani went bankrupt. If that happened, that's fine. Now your insurance company will take the control of your securities, and they'll fulfill or settle your entire amount, full amount of investment in your account. Why? Because you are paying insurance or premium, I would say premium every month or every year. So this is how CDS works, credit default swaps.
Okay.
What
Yeah.
about, sir, interest payment? Here, just think about, why we can exchange, or why we want to exchange, let's say, interest payment. What could be the reason? If you see, there are two things in market. One is flexible interest payment or floating interest payment, and another one is fixed one. So when we say fixed one, let's say you are paying interest payment on your home loan, which is 8%, and that is a fixed. And in market, the same means for a same home loan, if you see, the floating interest rate is 5%. Which one is best than floating one,
Floating.
right?
Yeah.
But in means at the time of initiation of your loan agreement, you have already signed agreement with bank that you want fixed one. So you cannot directly means go to the bank and ask bank to change your interest payment, right?
Yeah.
So you have signed the agreement. Then what could be the best option? So you can go to the market and check if someone is ready to exchange that floating interest payment with you. And let's say I'm that person, I'm, let's say, bearing 5% interest payment on my loan amount, and that is a floating. Now I will exchange my floating interest payment on same loan amount, let's say 1 CR. I'll exchange that with you. So it means you can send, let's say, 8% interest payment to my accounts. I'll send 5% interest payment on 1 CR, is that amount to your account. So this is how we can exchange interest payment. So now your question would be like, so why you would do this? Of course, risk. As I said, maybe let's say what if in next month that RBI changed the interest rate. So they have increased the interest rate due to fear of, let's say, recession or maybe inflation. Depends on the situation. If RBI increase that interest rates from 5 to 9, then you would be in loss, I would be in profit. I'll still pay 8%, you will pay 9%. Why? Because you have exchanged your fixed interest payment with the floating one.
Okay.
And what about currency swaps? Currency swaps, it means we can exchange the currencies. Let's say you want to travel in US next month, right? So you need a dollars, then you can deposit your INR with the bank, and you can ask bank to provide you dollars. So that's how you can exchange currencies also. So that becomes your currency swaps or exchange. All right.
Okay. Yeah. Yeah.
Then after forward it means if I talk about forwards and swaps both are OTC product. OTC it means you would see only in
Over the
market.
counter.
Yes, over the counter. Forward contracts, it is a customized contract. Customized it means let's say A and B both can decide terms and condition and they can sign it. They can directly sign that contract. So that becomes your forward contract, more customized. There would be another type, as I said, future contract. Future it means it's a listed one. So here you would see those are listed product. Listed one. Stock exchange manage that. Stock exchange manage that. Future. So you can buy and sell future. You can buy and sell the contract. Depends on your requirement. Future has a monthly expiry. Future contracts has a monthly expiry. Future contracts require margin. So what is margin? Margin it means it's an advance amount that you need to pay at the time of entering in the any contract. So can you please explain with the example? Okay, let's say if you want to buy Wipro securities. Wipro security market price is 400. The broker will ask or stock exchange will ask to pay 10% margin on let's say Wipro security. If you want to buy that, let's say 40. So you can pay 40 and buy one shares of Wipro under future contracts. So it means you have paid 40 rupees and book that particular stock. You haven't purchased it, but you can purchase that in future. So now just pay the 40%, 10% amount and take the position. That's the difference. So it means with the future contracts, you need a margin, right? Now your question would be like, sir, what about forward? Then don't we require margin? No. Initially, you don't need to pay anything here. No initial margin required. In both the contracts. And then last one would be options. When we say option itself, they explain everything. So that gives you option for a call or put. Call or put it means buy
Buy and sell.
and sell. You would see two types of options. One is European options and another one is American. There are other one as well, Bermudian. There are famous one. American and European. So what is the difference between American and European? American options you can execute at any point in time. Means before maturity also you can execute it. Right. But European one only you can exercise on expiry date only. And that's what if you see on our stock exchange as well, we have a European options. We have European options. Call, put. I'll show you that maybe in other sessions. If you see,
Okay.
we have European options. Call and put. So here means you can, so under call also that you can see like buy call and put call.
Sell call.
Sorry, buy and sell. And same for this as well. So you can buy and sell put. Options will have a weekly expiry. Options required premium, and this should be your rights to buy. Option holders will receive rights to buy or rights to sell. For option holder, total loss would be total premium, and option writer, total profit would be total premium paid by the holders. All right,
Okay.
you can note down this one. But as I said, every topic is a very vast. Then it will take 6 months or 1 year training. Then, if I
Okay.
get into the details of each and every questions. But yes, if you see any question around it, you can explain like this, at least with one small example.
Yeah.
I'll try to touch your another question also. Corporate action is a big one, so I'll cover that next session.
Okay.
I'll quickly cover your investment banking definition concept.
Okay.
As an experienced working professional, nobody is interested in definition, as I said, and nobody asks even like the difference between commercial and investment banking. But
Okay.
if you ask me, your investment banking comes under, sorry,
You have written commercial banking.
yeah, means investment banking comes under your commercial banking.
Okay.
Right. Commercial, it means it is for a commerce. Commerce, it means it is for a trade or business. So when we say business, it can be anything. It can be your trade finance, it can be your international finance, it can be investment activities, right? So investment banking comes under your commercial banking. And if you again ask me like difference, when we say investment, it means your investment banking support for a trading of securities, trading of investment securities. And when we say commercial, so in other way around, with this support to the institutions, raise funding and even provide funding. Institutions like TCS, Reliance Group, Adani Group, right?
Okay.
Means at a larger level where they offer that funding and all. And investment banks, as I said, trading of investment securities, and they support to the people like us or even institutions as well. Institution as well. So that's the difference which you would see between commercial banking and investment banking. So that becomes your question 4. That is all about investment. So you can put example like equity, bonds, debentures, that comes under your trading of securities, right?
Okay.
Where you can investment banks offer even IPO, stocks, mutual fund or lease fund, or different funds.